What are questions regarding life insurance? Number one, do I need it? How much should I purchase? What kind of life insurance? How should the life insurance benefit be received? So let's just kind of go through those. Do I need life insurance? Like we said before, probably over half of you here don't need life insurance. There's no one that depends on you. But if you have children, stay-at-home spouse, parents, and it's available at a reasonable cost, you need it.
So like when we were married, we had 7 kids, like when the kids were still home. He had life insurance with his company that was automatically taken care of. And then we had a little bit of life insurance also on me in case something happened to me, because he was still working, and then we would need someone to help take care of the kids for at least a little while.
Yeah.
So
be careful too. Well, my company had really inexpensive life insurance. So for it was like $2.50, I could get $10,000 on each one of my kids. So some companies allow that, and for like $15, I could get a good policy with Sister Sedgwick's. So realize oftentimes the company has good insurance. The risk here is if something happens to you, you get your health goes bad, you lose your job, then you lose your insurance too. So be aware there too. Other reasons you might need life insurance: you got a lot of debt, you want to have a big party when you die, expensive funeral plans. I have friends that have special needs children. I have a good friend who's got a special needs child. She's 34. She's still about the mentality of a 6-year-old. And when he passes away, he needs to have about $1 million just to be able to take care of his daughter until she'll, for her lifespan too. So not everyone needs it. If you're single with no dependents, if you're married, you have no kids, and both of you have your education, you might not.
And then like right now that we're retired and we already have quite a bit of money saved into our retirement, we don't have life insurance anymore because we don't need it anymore. Because if one of us passes away, the other one's taken care of automatically with our own money. So we're okay.
So we have, and ideally you can get to the point where we call it self-insure.
Yeah.
And that's where we are. So here's the question: how much do you need if you died? So you need enough to meet your goals. So if you're married and you have children and your mortgage is not paid off, you probably need enough to cover the mortgage. If your spouse does not have her education, you need enough to get her to school for 2 or 3 years or 4 years to get a degree. You want enough to pay your taxes and funeral expenses, enough to help your children, maybe pay for their missions and education.
So, and also just to live.
Yeah.
But so on here, we want everybody to get out your computer and download this calculated life insurance needs. It's learning tool number 8. And this will be attached to your insurance PFP that's due like next week. So if you do it right now and save it, you'll already have it ready to go for your PFP, and you'll just paste it onto your PFP.
So let's do that.
Insurance template.
Everyone, tool 8. So again, these are the questions that impact how much you're going to need. So Ryan, how old are you?
I'm 23.
23. Are you married?
No.
Okay, let's. If he's 23 and married and no one depends on him, does he need insurance?
Life insurance.
Does he need life insurance? No. Let's make a situation. Let's say he's 25 and he's married and he has 1 child.
Oh, you're going to change it.
Okay.
So put 25. This is after college.
Yeah, this is
and
after
you're already
college.
married and you have a kid. Okay?
Okay, let's say you're making a salary, let's say.
How much do you think you're going to make after college?
A month?
Yeah.
No,
A year.
A year?
How much do you want to make every year?
50,000, something like that down.
Say 80,000.
Okay?
Okay.
So you've got,
Returns.
you'll probably be more than that, but
Please
that's all right.
return.
Okay. How many years are you going to want to replace the income? Your son is 1 year old. How many years are you going to want to replace that income?
Till he's 18.
Yeah,
So take 20 years.
Okay, 20 years, and also to take care of your wife, so your wife can stay at home to work with that. Okay, 20 years. Current annuity interest rates are probably about 4%. I just put it in there, just put 4%.
Do you want the payment at the beginning of the year or the end of the year for your wife?
beginning.
Beginning of the year.
1.
So 1.
Okay, if you're single, it's 0. You get 1 point for your wife and 1 point for your child, so you'll have 2 there.
2 there.
What they found is that when the breadwinner passes away, there's actually the needs or expenses actually drop significantly when it's just 1, but as you have more kids, it doesn't drop as much. And so we incorporate that into
And you don't
that.
have any current life insurance, so put 0.
Okay, we're going to talk a little bit later about your nominal return on earnings. For most of you, I think it's going to be around 6%. But we will start this next week. But just
6%.
take my word for it. A 6 to 7% return is a good return.
And the marginal federal tax rate?
Okay, what's everyone's marginal federal tax rate? Everyone here is at the same one, except for Christine. It's 10%. And what's the marginal tax rate in Hawaii? It varies depending on your salary. Why don't we just put like 14%? Okay, estimated inflation rate, let's just put 2% down there. Okay, how much, in 2 years when you're married and have a child, are you going to have a home?
Mortgage? Yes,
Probably.
say yes.
How much are you going to owe on it? Okay, a lot.
So
You want to put it?
300,000.
Okay. What does it cost to die? It's not cheap to die. Probably 10 to 15,000.
Okay. Okay, that's
Okay.
good.
Do you have any other debts? Any student loan debts? Things like that.
Say 0.
Okay. Okay. Thank you. So now, appreciate that. Go ahead. So those are the inputs into the decision. Now
So that's all you have to do. You have to fill out this part, but then you'll attach the whole thing to your insurance plan. But the green stuff, remember, you only enter in the green.
Now realize there's no one single way to calculate how much your life insurance needs. I have a brother who's sold life insurance, and they have like 15 different ways. And so what we did is we came up with 5 of them that we thought were good ways to think about it. So first one is multiples of income. This is a big Dave Ramsey one. Just said 10 to 15 times earnings. So, and mix, what was his name?
Who?
In his place,
Oh, Ryan.
Ryan, 10 times salary was 500,000, 15 times 750. So in that case, it would say 10 to 15 would be about 625,000. That's about how much that his wife would need, or spouse would need should he die. And then what would happen, the spouse would take that money, could invest it or put it into an annuity and then pull off that $50,000 a year for those 20 years. There's 2 major types of insurance. One is called term insurance, which is really just pure insurance. And the other is permanent insurance that includes pure insurance plus an investment component. The downside is insurance is by nature very fee heavy. I mean, it's just very expensive. So let's talk about the difference between these two. Pros of term insurance, it's inexpensive. It's really easy to understand. It's easy to price too. They have what they call mortality tables. It says, okay, for a 21-year-old male, which is with Ryan's age, it's like 0.006751 times the chance of him dying in 1 year. And they're pretty good at those tables. They've had a lot of historical information. So it's easy to price. You can get it for longer periods. It used to be a term policy, you get it in year 1, then they had to approve you for year 2. Now you can get 10-year and 20, even 30-year level term policies. So you pay the same amount. With normal term insurance, Ryan right now would be really cheap, but each year it gets a little bit more expensive because the odds of him dying increase every year. And then by age 65, it's prohibitively expensive just because they expect most people die in the next 20 years. So again, it's a good product here. Downside, there's no investment value, but you guys are better at that. You can invest that better. Again, after age 65, you generally can't purchase it just because it's a lot more expensive. And you have to reapply each year for coverage, and they don't have to accept you. In order for me to get term policy, I actually had to have a medical exam. And I'm at high risk because my mom passed away at age 53. So I have to pay more for life insurance. And then the other thing, too, that you have to realize, if you die outside of the coverage period, it's not any good. If you have a 1-year policy and you die one day beyond 1 year, it doesn't help you out at all. Okay, permanent insurance. Again, it builds cash value. It's an insurance component plus an investment component. So premiums stay level.
They're high.
Yes, they're high. Permanent insurance is about 20 times more expensive than term. Tax-deferred growth of cash value. And as long as you're making your payments, the company can't cancel the policy.
But we don't recommend it.
Yeah. So what are the negative? Low returns compared to stock investments. Again, very high commissions. Compared to term insurance, it's 20 times more. So one of the challenges is, I have a friend who sells insurance. And if he sells a term policy, let's say it's $20 a month, he'll make 5% on it. So on a $20 policy, it makes $1 or $2. But on a permanent policy, the first year he can make 80 to 120% of first year premiums.
That's a lot.
So if you're, instead of, this one's paying $20, this one's paying maybe $1,000. So times 12,000, then he can make $13,000 to $15,000 on a single thing too. So if it's that good of a product, why do they have to pay such high commission? So just be aware, very complex, not transparent. Also, they use what are called illustrations, and illustrations can be misleading. And finally, the last thing, the company can actually, if the company's not making enough money on your life insurance contract, they can actually change the contract after you have signed the contract to be more in their benefit. So just realize there's a concern there.
There's a downside.
There's a downside. What determines your premiums? Length of term, age, face value, sex, health factors. Like again, my mom had a heart attack, that has an impact. So family history has an impact as well. What do we recommend for most people? Basically annual renewable term. Unless you have a medical and insurability problem, and then there's a few other places, but for most people, it's like Dave Ramsey says. He says it's buy term and invest the rest.
I'll just go over here.
And then, let's say you have a policy. How should the proceeds be received? And 90% of the time, people just take the lump sum. So realize that the life insurance proceeds are not taxable to the beneficiaries as income. But once they invest that, then their earnings are taxable. But you could do an interest payment, you can do an installment, you can do a life annuity. Insurance companies can do all of those things. So lots of different ways to receive it. But again, most people will receive it just in the lump sum. So one other thing you need to realize with insurance is that different insurance companies price risk differently. Different ones, if you're a smoker, certain companies will not price that as heavy as other companies. So you really need to do your homework. You need to go through and look at the different policies. Look at the companies as well too, to make sure that they're fairly high risk. But compare your life insurance quotes. Let's say Ryan decides after he has the baby they need to go get life insurance. Sit down with 2 or 3, find the different options, and then just compare them. You know the questions to ask. So when it comes to life insurance, what's the bottom line? If you have kids, you need it. If your spouse does not have her education yet, you need enough, and in case you died, that your spouse could go to college and get the education she needs, or he or she needs to survive. What do we recommend? We recommend term life insurance. and then invest enough funds to be self-insured after a couple of decades. Again, we're in the point now, and we probably could have stopped our insurance in the 50s, but we had sufficient funds to self-insure. And that's kind of where we are right now. Again, when is whole life or permanent insurance? The only thing there is if you have a pre-existing medical condition. Again, with term policies, they can make a decision every year whether they're going to take you. But if you have a pre-existing, you may have that may be worthwhile to go into. I know some people who don't have the discipline to invest each month, but they're very good at paying their bills. It's like swatting a fly with a sledgehammer. It does the job, but it's probably overkill. So just be careful.
Appropriately involve yourself in an insurance program if it's available, because you are responsible to take care of your dependents or somebody who's depending on your income.
Okay. Thanks, everyone.
Thank you.